mortgage rates could hit 8%. A new article just came out this week hypothesizing that that could be our reality. We're going to talk about that next. My name is Ryan Skaggs, and this is the Mortgage Minute. This channel is dedicated to everything mortgage, real estate, and interest rates. So, thank you so much for tuning in. We're going to talk about a new article that came out from Zillow saying that mortgage rates could top 8% this year, likely even by September, if and only if, and here's their hypothesis, if the U.S. cannot figure out the debt ceiling issue. So basically, what the hypothesis or the article read is that, hey, we could see interest rates rising exponentially. Now, our current high over the last, October, November, our high was 7.08 according to Freddie Mac. That was our high in the last decade. Obviously, we may have, like, my parents had a mortgage that was more than 10%, right? So it's not an all-time high, but at least over the last generation or 10 years or a few decades, absolutely a high. So 7.08, and they're projecting to go up even from there. Well, what they're essentially saying is if that we do not reach or come to some sort of agreement with this debt ceiling, that the Fed and other kind of levers and buttons that we would have to push would thus push interest rates up to that 8% range. So what would happen to the overall market if rates moved up to that? We saw this back in October, November. We saw mortgage rates push up, demand plummet, sellers start to panic, and then potentially lower those prices. Now, right now, we have a very low inventory number, so it wouldn't be the same as when we saw these huge inventory numbers back in 2008, 2009, 2010. But with that said, that could be an immediate punch to the mouth, an immediate shock to the market. Now, here is why that's likely not going to happen. So, and I'm also going to project to you what comes next here. So, if you look at that chart from Freddie Mac, you'll see the chart go up in October, November. That link is below. By the way, while you're down there, hit that like button, hit that subscribe, and click that bell icon to be notified of putting out weekly videos on the channel. Now, if you look at that chart, you saw that move up, right? So then from there, we've essentially kind of come sideways. We're down into that mid-6 range and we're going sideways. I believe we're going to continue to do that because we've seen the president come out and say, hey, we're going to figure out this debt ceiling. McCarthy, all these other kind of politicians coming out here and saying, we're going to figure out this debt ceiling issue. Thus, this article making a point of what if we don't? I do understand. I think that would be a little chaotic and panic-driven to say that we're going to get into the eights. I don't believe that to be the case. I do believe that Fannie Mae, Freddie Mac, National Association of Realtors, Mortgage Bankers Association, and plenty more that have projections that show us rates in the low 6s to high 5s is going to be reality by the end of 2023. So I'm not going to get into the mechanism of what overall is going on, but I would love to hear from you. Do you think that we're going to see higher interest rates by the end of the year? Put a yes or no. What do you think? Do you think we're going to see higher interest rates? Do you think we're going to have more causes for concern? Those causes potentially, just so you're aware, could be things like we have not handled inflation as well as we thought. Right? So when we continue to see higher inflation numbers, that's going to likely mean or correlate to higher mortgage rates. When we see, hey, inflation is potentially down, that potentially means that the Fed will start decreasing their Fed funds rate. That's also going to mean mortgage rates are going down. Like I said, with that Fannie Mae, Freddie Mac, National Association of Realtors, Mortgage Bankers Association, all their projections are showing potentially like high 5%, a few in the low 6s. What will happen if we get to the to the high 5s and low 6s? As we see another 0.5% in interest rates start to come down, we're going to continue to see more and more headlines. They're going to say, oh my gosh, interest rates at a 30-year or 30-day low, 90-day low, blah, blah, blah. That's going to continue to drive more buyer demand. And if we still have that super low inventory, demand is going to go up. We're going to have more offers on each property that are out there, which is going to mean prices are going to continue to appreciate. So in my hypothesis, for most markets, I'm continuing to tell people, buy now, you can refinance in 6 months, 12 months, 18 months, 2 years, whenever interest rates come down. But if you think you're going to buy now or maybe in 6 months or something like that, or maybe the next year, I would contend you're likely going to see higher demand in those times than you do now. Now, if you're going to go jump on a sailboat and come back in 36 months, then maybe that's the play, right? In 36 months where we potentially see higher or low interest rate, who knows? But with that said, if you're thinking about, do I buy in 2023 or do I not? What do I do, right? My hypothesis, my point would be is we're going to likely see higher demand in these times if rates move lower with the same amount of low inventory. So do you think we're going to get to 8%? What are your thoughts? Yes or no? What do you think is going to happen? Would love to see your comments below. Again, this is the Mortgage Minute, putting out weekly videos on the channel. Click that subscribe button. It's absolutely free. I'd love to see your comments below. Stay safe, and we'll see each other again very, very soon.